So Chris's claim that banks create new money only by lending is simply factually incorrect. The fact is, commercial banks rarely purchase bonds for investment purposes directly from the Treasury or from another bank or from the Fed. Almost all the time, they purchase bonds from a non-bank investor on the open market. When they do so, banks, in fact, create new bank deposits in the bank account of the seller of the bond. And this adds to the money supply just as if the bank was making a loan. Now, this should make sense because buying a bond and making a loan are essentially the same activity. When making a loan, the bank is purchasing the borrower's IOU, or promissory note, and the bank pays for this by creating new bank deposits. Similarly, when purchasing a bond, whether it's a treasury bond, a corporate bond, or a municipal bond, the bank is buying the borrower's IOU by creating new deposits. So Chris's claim that banks create new money only by lending is simply factually incorrect. And again, don't simply take my word for it. In my book, Black Hole, I include many scholarly references to validate this position. And here is one reference from the Bank of England's 2014 paper titled Money Creation in the Modern Economy. Okay, I'll just read the relevant part of this quote. When banks purchase government bonds from the non-bank private sector, they credit the sellers with bank deposits. And as discussed later in this article, central bank asset purchases, known as quantitative easing, have similar implications for money creation. Now, here's a quote from the very excellent book, The Age of Debt Bubbles. In addition to creating money when loans are made to customers, banks also create new money when they make purchases, either from individuals or more commonly, from companies and governments. It is worth reiterating this point. When a bank purchases government bonds, it typically does so by creating new money out of thin air.